Good morning, everybody. It is July 10th, 2020, 1 week away from a big options expiration day next week. And we will talk about that throughout the week, but in particular on Tuesday of next week, we are going to go through the ETFs that we are focusing on and just take a look at some of the things that drive me to make the decisions that I make, in case it might be helpful to you. So let's start with an update on coronavirus. I haven't been showing all the stats like I did a few weeks ago and a couple of months ago because they're all over the place. Everybody knows that the number of cases is rising, and it's not just rising because we're testing more, it's rising as a percentage of the tests that we take. So 4% of the tests, and then 5% of the tests, and then 6% of the tests, and rising have been positive. So that is indicative of a spread rate that has risen above 1, meaning that for every person that has it, they're giving it to more than one person. That number is at about 1.2 right now, depending on whose measurements you're using. So that means that for every one person that gets it, 1.2 people are getting it. So one person, and then, for every one person that has it, a 6th person gets it. That's not good, obviously. Death rate has been relatively flat now for a few weeks, 600-700 a week. And that is attributable to improving treatments. But because the number of cases are going up, the deaths aren't going down, and that is a problem. If we were having fewer cases, the deaths could fall because the care has gotten a little bit better, and that comes from trial and error. Obviously, the doctors have figured some things out, figured out that hydroxychloroquine, or whatever it's called, the medicine that President Trump advocated, doesn't work. And in fact, the CDC and World Health Organization have told doctors not to use it. Hydroxychloroquine, or whatever it is. Oh, yeah. Somebody can write it down. I can't say it unless I'm looking at it. Study of 17 million people has pretty much narrowed down the risk factors, and it is basically anybody who has a weakened immune system. The problem for Americans is that's most of us. One of the main factors is obesity, and we know that something like 60% of the population, 70% of the population, it's a big number, well over half of us are obese. And I think that is a pretty clear indication of something that I heard way back in college, which is at some point in time, societies get fat, dumb, and happy. And I think we got fat, dumb, and happy for a while. That was actually a friend of mine's grandfather over in Grand Rapids, Michigan, and his friend from Great Britain. They had fought in World War II together. And we went over and did some fishing and drank some gin martinis with them. And it was basically gin with like a drop of vermouth. And these guys, they showed us their classic cars that they brought over from Europe back in the late 40s. Pretty awesome. But they had some perspectives on life that I've taken with me for the last 30 years. And, one of them is that we get lazy sometimes, and we don't pay attention to what's going on, and we just think it's all going to be easy. And then something comes up and gets us. And this pandemic is one of those things. We haven't handled it well at all. And hopefully we get a grip on it soon, because otherwise it could be around quite a while. Dr. Fauci, the CEO of Merck, really across the board, except for a couple of the RNA people from Pfizer and Moderna, they're all telling us that fat chance that we have a vaccine this year. and that really the middle of next year to later next year is probably what we're looking at. The RNA, mRNA, may got that right. The Moderna's RNA vaccine and Pfizer's RNA vaccine aren't likely to prevent the disease. Really, it'll meet the secondary endpoint is what they're looking at, which is that it just makes the symptoms not as bad. And that is a step in the right direction, but it's not prevention. And again, we don't know exactly where the hurdles are for stimulating the economy. At what point does aggregate demand pick up again? At what point do employers start hiring on net versus trimming? And that is something that we should keep an eye on. I will tell you, with regard to the unemployment numbers, I have said for a couple of years that when the unemployment numbers go up, that is when we should worry. Well, clearly the unemployment numbers are up dramatically. And I just point out that you should take with a grain of salt any optimism there, because as I told you 2 years ago, the EIA was lying about oil and oil inventories. We know that now with the level that we're at. And the Labor Department, or BLS, I forget who was the one that caught the error, noted that there's a mischaracterization, miscategorization of the unemployed. So we know that there are well over 20 million people who would like to be employed that aren't. And that's going to take a long time to fix. Again, I didn't show those numbers today just because I'll throw it into another article. We need to be very aware that things are not going well in the economy. And at some point, the stock market is going to reflect that, because even people with money don't want to buy stocks at these prices for the most part. And we're going to go through some things here to make it very clear to you that this is a market on thin ice, and you should be very careful. You should be at the conservative end of whatever your asset allocation, your strategic asset allocation range is. So when we talk about strategic asset allocation, those are the percentages of equities and bonds, commodities, cash that you gravitate towards. So for most people that I talk to, that's going to be about 80% equities and then 20% other things. And if you are younger, if you are in your 20s or 30s or 40s, you're really going to gravitate towards about 95, 96% equities, even pushing 100% equities as your strategic asset allocation. However, on the tactical side, you have to consider the shorter term time frames versus the longer term time frames. So tactically in the short term, you're going to move into either more aggressive or more conservative positions. Again, if you're a younger investor who should be 95% equities on average or a little higher, you're really looking at, okay, when do I dial it back to 75 or even 50% equity? And I don't think those times come around often, but I think we're there now. So if you're a younger investor, you should be tactically looking at, all right, do I want to pull back and just accumulate dry powder for a while? And I think the answer is yes. So I think 25 to 50% in cash is probably a great idea. And of the equities that you own, a pretty big hunk should be gold stocks. And I think that you probably own a little bit of gold even. The devaluations that are coming are going to be significant. I think that there's going to be some radical changes to the retirement system in America, because ultimately it doesn't make sense for the Federal Reserve to own securities when, heck, why wouldn't we just throw it into a Social Security trust fund? That's a long-term vehicle. It can hold things to maturity, and it can exchange debt for equity. And that's an idea that I think you're going to hear in the news a year from now, maybe 6 months from now. Depends on what's going on. I am operating from the base assumption that President Biden is going to be the reality. If President Trump wins again, then my base assumption was wrong and I have to adjust. But at some point, the United States is going to have to decide what to do with all this debt. Debt is in excess of what it was in 2007, and it is higher as a percentage of GDP than any time since World War II, so even higher than 2007. We have accumulated more debt since the financial crisis than we have had economic growth. So we're basically borrowing $1 to get about 95 cents in growth. And at this point, about 90 cents in growth. So let me ask you this. If you were opening a business, would you borrow $100,000 to try to make 90? That's exactly what we're doing. So we need to be very cognizant of the fact that the debt problem has spiraled out of control again, that it started a few years ago with the $1 trillion debts on the back of tax breaks for the wealthy and for corporations. And now with being on thin ice when this pandemic hit, I would say that we are not in recession right now. We are in a depression. And any talking head that comes up and tells you that we're not in a recession because we're coming up off the bottom is full of shit. That is, in farmer parlance, bullshit. There is no economic recovery going on right now. This is a dead cat bounce. This is rebounding off the bottom a little bit to reflect some aggregate demand that exists by virtue of the fact that parts of the economy are reopening, but we know that that has slid backwards. So for the next year, the economy probably drifts up a little bit until it finally hits an inflection point, and that inflection point will come when enough people have been vaccinated. Sometime in the second half of next year is what I think. Could it be the first half of next year? Maybe. The health experts say no. But if the RNA vaccines, which will probably be the only ones ready here early next year, can prevent people from having serious symptoms, unless they're, very compromised, then maybe things get better a little bit quicker. But my guess is that given that nothing RNA-based has ever been approved before, and that there are still serious safety concerns, I'm not so sure that those ever get to market other than as some sort of emergency treatment or treatment for the military, something that, people at the edge might use because they're going to be in high-risk situations. So high-risk vaccines typically don't get used with the general population. Honestly, it's the military. Some of the things that my military friends have had to take because they were going to Africa or they were going to places in Asia or the Middle East. SARS, MERS. There are vaccines for that stuff that are questionable on their safety, but they weigh it as, okay, is it better for the soldier to have the vaccine or not, given that they're going to be in the high risk situation. So I wouldn't hold out too much hope on a vaccine in the first half of next year having any significant impact on the general population. What I do know is that we should all work on getting healthier. I think that is just the bottom line. The thing that I have done, just for those of you who keep up with me in the chat room or on Twitter or something like that, is dramatically cut sugar. Really had 2 desserts in the whole month of June. I've had 2 in July already. We had a holiday. 3 actually. I apologize. I had to finish one, so it was 1 dessert spread over 2 days. and lost 12 pounds now, 13 maybe. And I think that is something a lot of people ought to focus on, is the combinations of inflammation from being overweight and from being over carbed, right? Having too many carbs um, is really something that people ought to focus on. And obviously, keto is real popular right now, but in the long run, you can't have that much fat. But it is a way to help burn off calories in the short term, to go pretty much meat intensive and then add vegetables in. And that's where I'm at. It's a lot of vegetables and meat right now. But I'm trying to eat lean meat. I'm not really trying to do the high fat thing. I take supplements when I need to. Figuring out all these things for yourself based on what your condition is and what your health is important. Because being more than 30 pounds overweight, that is actually a medical condition that can kill you. And it can make you susceptible to things like coronavirus, which obesity is one of the main things that they cite. So medical conditions such as obesity, diabetes, and as we know, diabetes and obesity go hand in hand. Severe asthma, and I have read several things that actually said that unless it's severe asthma, it doesn't much matter. Keep an eye on that if you got it. But really, heart conditions are a problem, right? So, a lot of these things tie back to just how we take care of ourselves. And I think that, if I was going to tie one thing in with our wealth management, I'd say, look, let's have better health management. I ignored my health for better part of 15 years, just because I was a pretty good athlete and faded off into the sunset and didn't take the changes to my body seriously. And at 50, I know that I better. So I am. And I'd encourage you all to do that too. So let's talk about the stock market. Joe Biden says, look, investors don't need me. He calls for an end of shareholder capitalism, basically inflating the market using monetary policy. He wants to focus on fiscal policy. I've said for 2 years that's the right approach. If you have a strong foundation to the economy with high employment and rising wages, the stock market will do just fine. And by the way, as I've said, I see it as an inevitability that Social Security starts buying the S&P 500 index, maybe the Russell 3000, but we'll see. I think the S&P 500 index would be a great bogey for companies to try to get to by becoming profitable and following good financial guidelines. So we'll see how they do it, but that will be a conversation that you're going to see in the news at some point, because it doesn't make sense for the biggest pension in the world, I believe, Social Security, to not have a stake in American equity. Now, I'm not saying that it should be a big stake. I think it should be enough to offset inflation. 20 to 30% is typically what that takes. So if we end up putting around a quarter of our money into Social Security money from our paychecks into the S&P 500 at some point, that would be good for the S&P 500, correct? So money flows matter, and rather than creating funny money that flows to the top 1% of the population, and us in the next 19% get a little bit of it, but really most of it goes to the top 1%. As I pointed out a couple of weeks ago, the increase in the national debt since 1981 is roughly equivalent to the increase in wealth of the top 1% of the population. Think that through. We've accumulated $25 trillion of debt, or whatever it is right now, and the increase in wealth of the top 1% is something like 23 trillion. And that's partially from the inflated stock market right now. So if the stock market falls, maybe the net worth of the top 1% drops a couple $1 trillion. But you know, that money is obviously not just the stock market, it's in real estate and business ownership and things like that. But let's consider the way the world is going to change. And in the research notes that I pop up once in a while from JP Morgan, from everybody else out there, they're all saying the same thing. They're preparing for a pivot to Biden. Why? Because the polls are overwhelming right now. I mean, this isn't close right now like it was in 2016. I mean, Trump is way behind. Can he flip that? Oh, sure. In the next couple of months, he absolutely could flip it. But right now, the big investment firms are preparing for a pivot to Biden, and investors should be too. So you as an investor should think, okay, what do I do if President Trump wins? And my advice is pretty much sell everything, because I think that the depression lasts a long time, although if he wins. And if Biden wins, prepare for a shock, which I think actually comes before the election, and then a pivot to the favored industries. And to that end, I have updated, and I'm not quite done, but this is a new watch list, right? I've added a bunch of companies. So the yellow are new companies: Caesars, Live Nation, MGM, Costco, Kroger. Slowly adding the charts for you, finding the bottom fishing prices. A lot of these need to be updated. Should all be done this weekend, because I've actually been updating the charts at TradingView. I just haven't plugged them all in yet. Going back to the ETFs. So I'm tracking 76 ETFs. Different categories. This spreadsheet is a fund flows spreadsheet. And it shows you, and I got this from ETF Database Pro, which I have. And I'm trying to get a discount code for you along with something else. So I'm going to have a number more discount codes. You can take what I give you. It'll generally be enough for most of you, especially if you're on margin of safety investing. You probably don't need to add much. You can pretty much just work from what I provide you. But if you're on fundamental trends and you're looking for more ideas and you're putting a little bit more time into it, and especially if you're swing trading, there's some of these other resources I have for you, you're going to want. One of the reasons why I keep my services cheap is so that you can have all the tools. So the fund flows shows, how much money is going into different places. So transportation, $250 billion, right? Broad technology, which is all the subcategories and industries, 15 trillion. This is where all the money's going, is in technology. Now, there's been the big rally in biotech, almost 3 trillion, and in oil and gas. And we're going to talk about oil and gas, where the rally is coming from. Then you take a look at the places where there's not so much money going in or money is coming out. And I would just like to point out broad real estate. Real estate's losing money. Why is that? Because there's a reckoning going on in retail, and commercial's not far behind. MLPs are getting pummeled. Why is that? Because as I've talked about over and over and over again, you're not going to see increasing demand in oil ever again. I mean, a little rebound here, but never going to have increasing oil demand again. And these pipeline companies are running into all sorts of problems. One, it's harder for them to do maintenance. They're not allowed to replace things because there's always opposition. And they have customers, the oil pipelines, right, have customers that can't pay their bills. So they're going to go quarters and quarters as bankruptcies go on of not getting paid full rate. So the oil pipelines, we may be able to find a bottom there, but as I've told you, the only ones that I'm interested in now are the natural gas pipelines, because it's the cleanest of the fossil fuels and it has a longer shelf life. Could I swing trade oil MLPs? Maybe, but I don't think I'll ever own them outright again. Consumer staples have been losing money because we've pivoted cyclical. Weirdly, internet, not getting money. Natural resources. The gold miners, for whatever reason, people have been taking profits. So some of the things in your head may or may not be true because the fund flows are speaking otherwise. What I think with gold miners makes sense to me, and I don't know it to be true because whoever knows, is that there's a lot of people taking profits to buy technology. So people who bought gold in the first quarter of the year probably have sold it in this last quarter to pivot over to technology. We saw how the gold miners bounced around for a while and just started to break back up. So my guess is people are putting money back in the gold miners again now. And it's not really a guess. So one of these services I subscribe to is Data Trader Pro. Again, something else I'm trying to get you a discount for. And we can take a look at different sectors. It tells us where the block trades are. So there's been a lot of activity in financials. Not so much here. Then some activity in emerging markets. I just want to point this one out. Block trades in the UUP, positive dollar. None. So that might make you think that the dollar is headed for a downfall. Not really. Good, right? Good and real traders in currencies don't use these freaking ETFs. They use the futures market. So all the activity in UUP is small investors, little guys. Big investors and real traders use the futures markets for currencies. So keep that in mind. Any of these futures-based contracts, you're getting front run by the futures traders, and you're paying high expenses, and you're dealing with contango sometimes, like with USO. These futures-based ETFs, for lack of a better word, are a scam. It's a racket. There's like a dozen people that run USO, and they make a ton of money because they don't go out of their way to explain to people that futures-based contracts don't work. Now, some of them are better than others, but for the most part, you must track contango and backwardation or you're a sucker, right? In poker, if you look around and you don't know who the sucker at the table is, who is it? It's you. So if you don't know backwardation and contango, and you're using any type of commodity ETF or anything like that, or currencies, you better be very, very careful. All right, so with Data Trader Pro, I can track a lot of things. So right now, we know that there's not a lot of buying pressure in the market. So I actually went a little bit shorter in the last hour because I expect that next week is going to be a rough week. Why do I expect that? Because in tracking the money flows, and this is real quant data here, right? This is the stuff you could plug into an algorithm. What I am seeing is that the cumulative dollar weighting buying pressure is very low, right? We had some negativity here, a little bit of a rebound, and then some chop, a little bit of up, and now it's back down. And why is that? Well, combination of this and coronavirus. So I'm not going to walk through everything that Data Trader Pro has today, but I will tell you that it's got some pretty nifty tools that make it very easy to know where we stand in the market with, buying pressure, whether supply is in demand control or demand is in control. If supply is in control, that's negative, right? Excess supply of stocks or ETFs. And if demand is in control, that means people are buying, and prices are going up, right? So we just saw that arrow turn red, and that means the NASDAQ must have just turned down right now. Is that true? Let's find out. Yes, look at that. NASDAQ just turned down. Right. So it was, I just want to look at a one-day chart. So it just started, right? It had its rebound, then it went negative, right? The pressure went negative. The price is still holding up. But the indication here, this would be a negative divergence. The indication is that this is going to come down. Does it come all the way back down here? I don't know. But if you take a look at the volume was high for a while and then tailed off. That could just be Friday, right? Or it could be an indication that you're exhausting the buyers. And I think that's the case. I've been watching all these numbers on all these charts across the board, and my conclusion has been that the buying pressure has been dissipating. All right. So TRIN is a measure, this is basically for day traders, but TRIN is the trading index, and it is showing that things are starting to move in the wrong direction. Now this S&P 500 is pretty strong today, and I'll show you something else in a minute on the back of Vanguard investors. So a theory that I would throw out here, something to keep an eye on, is that Vanguard investors believe just invest in a dollar cost average in the S&P 500 forever and hold it. And that's fine for them. In an era when the Federal Reserve propped up the market for a decade, that worked. But I would ask people who indexed from 2000 to 2009 how they felt about that, because they didn't make any money. They made about 2% a year for a decade. I've told you, I think the S&P 500 is in trouble. A lot of companies are never going to make money again. A lot of them are going to go bankrupt. And some of the ones that stick around, they're just going to be paying off record debts for a very long time, which means they're not going to be able to throw off cash to shareholders. We know that the buyback bubble is just about, to go, right? The buyback bubble's in trouble. So this is today's action. We can see there's not a lot of buying pressure, not like there was. As these move, right, in this direction, right, and they're coming off of being up here. So I say they're moving in the wrong direction. You say, well, look, it's not so bad. It's still in the blue. No, but it started here, right? And that was yesterday. That was yesterday. And this one's still about right. But as it moves this way, gonna have problems. All right. So if you're at Fidelity, they have a good explanation of what the ARMS index is, or the TRIN. We're gonna have about 60 ETFs in here, and we're going to use the money flows extensively going forward. Had a client, 3 clients actually called me this week. One fired me because I wasn't being aggressive enough. The other 2 threatened to fire me because I wasn't being aggressive enough. Fine. And I know that I've had subscribers leave because I wasn't being aggressive enough. I'm going to give you that option. I may or may not be as aggressive as you want to be, but if you want to be more aggressive than me, then have at it. I will give you the best performing sectors and industries, and you can decide whether or not you want to, go after it. I don't advocate chasing returns, but if you're a nimble trader and you understand the technicals of what you're doing, then have at it. That's what the fundamental trends rare swing trading services is for. But I'll tell you, it's only about 80 or 90 people who use that out of over 400 subscribers that I have. 450 subscribers, I think we're up to. And less than a quarter want to swing trade. So if you want to swing trade and you want to make more frequent asset allocation changes, head on over to the rare swing trading room. And in fact, I can even give you the discount code, because right now it's 75% off. If you're at margin of safety investing and you want to swing trade, just go to the add-on because you've got your own discount. There you go. This is running till the end of the month. Oh, this one's from Mosey. Oh, I don't know. There's a discount. It's the discount is Rare Freedom, capital R-A-R-E, rare in caps, and then Freedom, capital F. So if you want to try that, go ahead. I'll pop it up in the window on YouTube. So let's take a look at ETFs and then get out of here in a reasonable time. So, like I said, I use ETF database, the pro version, to compare ETFs and track them. I like to follow money flows, right? Because we know that those are the stronger sectors and industries. Take a look at money flow year to date. It's the Vanguard S&P 500 and then QQQ. Weirdly, and I showed that to you before, is that SPY that was up here a second ago, SPY has actually had outflows this year, but it's more than offset by the S&P 500, right? So the Vanguard investors, because of their dogma, right? Because they're just dripping in dollar cost averaging and always into the S&P 500, that's their core investment. You should think to yourself, how can I make money on them never changing things? How can I make money on the fact that they do the same thing over and over again? The easy answer is we can front run them. We can front run them when things go up into the better sectors, and we can front run them when things go down. And then we can count on them to put more money in just about at the wrong time. And we can count on them to take money out at just about the wrong time, which isn't often. It takes a lot to get a Vanguard investor scared. The reality is they just dollar cost average in. So, given that these are market cap weighted indexes, that's why those biggest 10 stocks just keep crushing everything. But right now, the hedge funds have been bidding everything up. Other than the Robinhood traders and millennials and the various dumb money groups, the hedge funds have been taking both sides of the trade. They've been buying and buying and buying, but also hedging and hedging and hedging. So they're helping keep the stock market up. But at the same time, they have a lot of short bets through the election. So what do you think the hedge funds are going to do if they're the ones holding the carpet? At some point, the hedge funds are going to sell en masse. When the hedge funds sell en masse, that's going to crush a whole bunch of kids who just discovered call options. There is a record $20 billion short against Tesla right now. So either you're going to see Tesla go to 2,000 on a short squeeze, or the hedge funds, which have both sides of the trade, are going to find a way to make sure they win. So how do the Tesla shorts win? Well, seeing as they've been part of the run-up in the stock, because they're like I said, taking both sides of the trade, all they have to do is start to sell their stock at a weak moment in the market. So there's going to be a lot of things. And Elon Musk control anybody he wants. He knows that the stock is inflated. He knows that that company's not worth more than Toyota. Toyota makes 30 times more cars than Tesla. Tesla ain't going to catch them for a decade or longer because Toyota is moving all the hybrids and they're bringing on hydrogen trucks. So you saw Nikola, a stock that I told you about before it was even called Nikola. I said maybe take a 1% position, and I just said it softly. Right? If I say something, just listen. Because there are a lot of things I could talk about, but I choose what I talk about. Nikola went up, what, 500%? I told people to buy it between 7 and 11. I went to, what, 50, 60, 70? And why was that? It's just the hype. I don't know if Nikola is ever going to make money. I do know, because we talked about it way back in January, that hydrogen trucks make sense. And that's what Nikola is doing. So we'll see where that goes. Now, when I take a look at the sector list of ETFs, again, we can see Invesco QQQ, and this is one reason why I'm invested in Invesco, the company, is the most popular ETF out there after the Vanguard 500. And it's just crushing everything else. Weirdly, the energy sector is up. I just like to do a quick aside. The energy sector has rallied and then fell. And I wrote my last article about sell Exxon right about there. And we shorted Exxon a couple weeks ago, correct? How many of you followed me on the Exxon trade where I bought Exxon puts? I hope more than one or two of you. I know a few of you did. Well, interestingly, who bought? Hey, look, the Robinhood folks loaded up on Exxon when it fell, or loaded up on the XLE, Spider Energy ETF. And now their buying pressure has leveled off. Remember I told you the buyers are getting exhausted? Those $1,200 checks are gone, folks. Price went up. They leveled off their buying. Price went down. Right? Buy, and drift out. Right? They haven't even drifted out yet. What happens when this turns over? And it will. This is going to crater. So if we go back, the energy select spider is on my suspended list. That's what the red means, right? Top ETF, new, suspended. And I have to add some yellow in here yet. It's not done. It'll be done this weekend unless I go to up north Wisconsin, and then it'll be done Monday night. But it's close. I've lowered the bottom fishing price on XLE down to 20, mainly because I think that Chevron doesn't go up anymore, and I think that Exxon is going to go down another 30, 40, 50%. Take a look at Exxon. We shorted it. We bought the puts right about there, right? So Exxon was about 49 when I bought my puts. And I bought $40 puts. I think I've almost doubled my money in 2 weeks, right? Wilson says he did, right? I think Exxon is under 30 by next year. And I think it could get all the way down to the single digits. I don't know if it will. I mean, it could hold up right around 30, 29, 28. But that's a big drop down. If they cut their dividend, they're going down to 10 bucks a share, folks. Royal Dutch Shell is a stronger company. They cut their dividend. Keep that in mind. BP cut their dividend, right? Or is BP just talking about cutting their dividend? I don't recall if they actually did it yet. Oh, one thing to take a look at. Another head and shoulders formation. Exxon's got it, just like the S&P 500 has it. Head and shoulders formations are very dangerous. All right, screw energy. I want to do just a whole report on that at some point. So what do we want to own? Well, the S&P 500 has that big head and shoulders, right? Option expiration in August. If this doesn't break out, right, it just about got to my resistance box, just a little short. Remember, we've talked about how the market will sometimes not, it'll flirt with you all the way up to the point where you think it's going to get to 319 or 320, and then it stops at 317, right? I think that's where it got to on this day, 317.05. Almost, right? Flirted with us. Buying pressure is flattening out. We know that the Federal Reserve's balance sheet has actually shrunk in the last couple of weeks. Not much, a couple bucks. But they've stopped adding money. Liquidity is no longer increasing. It actually contracted just a little bit. And then look what's happened, right? And in fact, if you go to the Fed website, oh, I don't know if it's this one or this one. It's one of those. Either Fred, St. Louis money supply, and bam, somebody already has it ready for us. So let's take a look at just the last couple of weeks. See, leveled off. And right there at the end, it went down just a little bit from 18,429, 18,424. So not much. But this obviously is the big jump in liquidity, and now it's leveling off. So that was your Uber rally, and now the buying is dissipating. And they have a few $100 billion more they can add in. They do. But you think they're saving that for a rainy day? I think so. So the puts that I own are S&P 500, August, 295. So SPY 295 puts is what I own. Where'd my chart go? Did I kill my chart? I killed my chart. So go to the daily chart. I own the 295s. If this heads down like I think it's going to, those 295s, which are at about $6 a share right now, you know, be 10-ish here, 20-ish there. And if we go all the way down here, I mean, they could be $30, $40. You know, I think that the SPY 295s are a good buy right now. I think they're the right ones. Because even if we just get in here, you should be profitable just by having some time value. Don't spend a lot of money just in case it breaks out because of whatever reason that we don't know. But we know that the Fed isn't expanding its balance sheet anymore. You know, what I should do is I should go even shorter, shouldn't I? Let's just go 1 year. Let's actually, right, there you go. Last 7 months. Giant rise. Flattened out. Right, that's it. Oh, that's money. And this is money stock. So if we go to my account, pull up my charts, we have there we go. Update this. Just look at it recently. So this is what I showed you a second ago, is just all the money they printed. Stock market, you know, followed along. But let's look at this just recently. Stock market fell off a cliff. They printed a bunch of money. Stock market went up. But if you see here, total assets on the Fed balance sheet have actually fallen a little bit. Why is that? That's because they have bonds, you know, that mature, and they don't roll them over sometimes. So August on this 295s. So even if this goes up just a little bit, right? How much is that going to support the stock market? Stock market got very choppy as soon as they flattened and turned over a little bit. I mean, that is such an easy relationship to see, right? Very easy relationship to see. So be aware that this is what's going on. So everybody that goes money printer go burr, they don't know what they're talking about. They think the money printer's still spitting out dollars, and it's not. They liquefied the market so that none of those corporations would go out of business. All these companies have pushed out their debt maturities 5 years. Okay. So our corporate bond ETFs have already appreciated to the first resistance level. Do they go a little higher? They do, maybe they don't. I think they're worth owning because the coupon is good. And we're keeping money in cash right now anyway. So if you're typically strategically looking to have 80% of your money in equities, holding some of Angel or Liquid, LQD or ANGL, it makes some sense in the short term and maybe even in the long term. If you are a younger investor and you're targeting 95% or more in equities, you know, for the long term, with pulling back once in a while tactically, you know, I still think it's better than cash, at least for a little while. And you shouldn't be buying all in one day anyway when you buy. You should be scaling in, so that allows you to scale out of Angel when you need the cash again. IWM, interesting charts. Index ETFs. I just want to take a look at the block trades. Not a lot of excitement for IWM. So these block trades are interesting. If you see block trades and it starts going down, that means the block trades were sellers. If you see block trades and the market goes up, that means that they were buyers. And usually you get more buying. But look here, had a couple of orders here. Couple of orders here. And it looks like they must have been sells. Market went down immediately. Market drifted down. Right? Another sell up here. Market went down. So you've got institutional sellers here. Right? If the chart would go up right after they made their trade, that means that they were buyers. So I'll tell you what, I've been I've had Data Trader Pro for 3 or 4 months now, and I'm a learning curve guy. I usually own something for a few months and I glance at it. And I finally started really getting into this to the point where I know it well enough now that it's useful. And knowing where these block trades are is important. Very likely this is Vanguard, right? QQQ. Really no impact. So we can actually go here and we can actually look at what the QQQ trades were. Pretty neat, huh? So we know what the block trades were. And given that QQQ is flattish today, kind of tells me that the buyers and sellers are about equal. All right. So when I pick out funds for this list, I do pretty comprehensive research. I want to know how things have performed relative to each other. And for a long time, the Invesco exchange traded low volatility ETF really did well compared to a couple other ETFs that are similar. Lately, it is not. Why is that? It's because it's underweighted in tech to control volatility. So, but all three of our dividend ETFs, this one, and this one are all pretty similar. So is this one. Guess I could have put USMV on there. We have some dividend ETFs, and they're all still expensive. I do have to adjust all these. They all need new charts. So let's take a look at ARK. ARK is one of our core funds. Look at the holdings. A couple of months ago, Tesla was about 4%. Now it's up to 11%. Why? Because Tesla doubled, tripled in price. A lot of these stocks have had huge rallies in the last 3 months. It would not be hard to see ARK. I mean, unless there's a major rally, I mean, they're already flirting with, the danger zone. I mean, unless that's a super rally here. And we don't have a lot of great support levels and resistance levels because we really have to tie it back to the individual stocks. In looking at that stock list, I can tell you everything on here can drop 50%, every single one of them, because they've all doubled. So ARK is at 80 right now. I think I wouldn't touch it above 60. And I still think there's a pretty good chance it goes down to 40. That's where the 200 week moving average is. So that would be a 50% drop. I think that would have to coincide with a pretty significant market event. So somewhere in here, if I had to pick one price that I'm looking for, C55. In fact, I'll even go to 55. Say 56. You have the one spot where we have some confluence that's one spot. The other spot is down here. So those two confluence points, here and here. And when you use my trading ranges, I would generally buy at any confluence spots. So multiple fibs there, multiple fibs there, multiple fibs there. So ARK at 56, 48, 41. And keep an eye on Tesla and the other top holdings. Stop it. This thing just, I don't know why it does that. They want to advertise that to me, but I'm already a subscriber. So keep an eye on those, especially these top 5 or 6, right? Square, right? Square is in all of these. What if ARK as a major holder just starts to trim everything. She does that. It's an actively managed ETF. It's not an index. So that's important. All right, industrial ETFs. I just want to show you something. Jets has been getting all kinds of money. Right? This is what's in there. Southwest Airlines, Delta, which is the only one I like. All these other crap companies. General Dynamics, okay. Who's buying jets? That's right. The Robin Hooders and the Reddit readers. That last article I wrote that had the stories about Robin Hood and Reddit, you should read that. Go back and read that one. So now suddenly they leveled off on their buying. Again, they only had limited funds. And they were borrowing on margin. And stock goes on. So all it took was for a leveling off of demand for the stock price to fall off. Again, I ask, what happened on the ETF price? What happens when this turns over? What happens when the Robin Hooders sell to buy a car or pay their rent, make their car payments or pay their rent? They've been part of the marginal demand along with the hedge funds. Hedge funds are taking both sides of the bet. That critical moment is coming in. I think it's going to be between next week and the third week of August. I think in the next month, you see a pretty volatile market. So when I compare industrial ETFs, I'm looking for best of breed, the ones that are optionable, so we can use options with them. And how do they compare? So I compared XLI, which is a Spider Industrial ETF, against RGI, which is equal weighted. And usually we want to use the market cap weighted because the S&P 500 and QQQ are market cap weighted and they're the biggest funds. So they push the big companies even higher, but only to a point. Certain industries, a lot of these companies don't get the top end of the index contributions. And what happens then? If they're not getting the top end of the index contributions, what happens then? I could tell you. Oh, where'd my RGI chart go? Phooey. XLI. We'll compare it to RGI. That was easy enough, right? And look at that. The equal weighted is outperforming the market cap weighted. Why is that? Because there aren't giant companies here that are getting huge amounts from S&P and QQQ. So you go back 5 years, hasn't been a big difference, but it jumped. About a year ago, it jumped. And the equal weighted started doing better. And when you take a look at the holdings, right? 74 holdings in both of them. Same index, but market cap weighted. So you take a look and you say, okay, which index do I like better? Do I want to own Union Pacific and Honeywell and Boeing, 3M and Raytheon at the top? Or do I want to own these? And I think in a defensive environment, you want to own this. But in a market that's going up, probably doesn't matter that much, right? And in fact, the market cap weighted did a little bit better. And here's why I think the market cap weighted, even though recent experience says otherwise, I think this might do better. Why? Because as the economy picks up, the choo-choo trains will do better, Honeywell will do better, Boeing is retrenching now, so they probably can't do much worse. 3M is coming back up. And Raytheon Technologies is one of our favorite stocks. Lockheed Martin's one of our favorite stocks. UPS is part of the whole work from home, order online economy. Caterpillar is going to dig up all the lithium. And General Electric is finally starting to pivot into alternative energy and energy management, which, what did I tell you? 2-3 years ago when I wrote that article on GE being in the teens for a very long time, said they had to pivot to actually being in electricity again. They had to become an electric company again. And that's what they're doing. Another railroad, Illinois Toolworks is a great company. Agriculture is going to have a rebound. Northrop Grumman. I love these companies as a group. So I'm going to want XLI, not RGI. There's times where this makes sense, but I think that these stocks are awfully good companies. Now, when you take a look at these, ask yourself, what do I know about FedEx? Pretty good company, you know, right there with UPS. Like them? Would I like a little more? Right? What did Mae West say? Too much of a good thing, right? It's always better to have more of a good thing. So, and I'm not saying these are bad companies, the ones that aren't on both sides. I mean, Fastenal has done really well. But we have to take a look at what projects are coming. And if we're going to do a $1 trillion or $2 trillion infrastructure project or $3 trillion infrastructure project over the next decade, these big guys are going to do really well. Now, we may want to cherry pick some of these companies, right? You know, somebody in our group might work with Otis. Somebody in our group might work with A.O. Smith. I mean, they're got operations in Milwaukee. Somebody might say, here, this is why IDEX is interesting. So I think we cherry pick some of these smaller stocks, but we have this index. And I think the industrials are going to do really well. So that's why I've been adding more and more industrials. So we're going to have a bunch more. And again, I have my spreadsheet. We're going to have an ETF for every one of these categories. Lithium, energy infrastructure. We're going to have it all. And we already did, and I whittled them down, and I'm adding them back because this data tells us what's getting the money. So if you want to be more aggressive with your asset allocation, say, I want to be in these things, you can do it now. I give you permission. No, I wanted to be so conservative the last year that I pulled back on a lot of the information, and now it's coming flowing back in. You know, do I want regional banks? Yeah, I probably want regional banks, but I sure as heck don't want these big banks. I think that's a mistake that the market is making. But some of these regional banks, you pick the right regions and you're going to do really well, right? And I'll tell you right now, Wisconsin, Minnesota, going to do really well. Why? Because it's getting so hot to live in other parts of the country that people are coming back. And we have water. The whole Great Lakes region is going to be a great place to invest. Look at those banks. That's my opinion. The data actually shows that it's already happening. All right, let's call it a day. Grandson is now here, and I'm going to hang out with him for a few hours, and I have to run some errands. But I want to see how the end of the market is today. Okay. Somebody wants to talk about GDX, so this will be what we finish on because it is a major holding for us, right? The old chart, we can rebuild it. We have the technology, we can build it, right? So there you go. It broke out above 36. I told you in the lower 30s to be buying it. You know, sell puts. So if a bunch of you sold $30 puts, like I suggested, those are basically just cash money now. I think in a general correction, this comes all the way back down towards 30. These are pretty spaced out. All right, but I don't think it gets much down below here. You know, could it get down to 25-ish? Yeah, things would have to get really bad. I mean, could you buy it up here about 32? Yeah, sure. You could buy it at 32, 33. I'm trying to be a little bit more precise than that. So I guess that's a bit of a confluence there, isn't it? I have my line a little bit off. So yeah, 32-ish. I think you could buy it at 32-ish. You know, again, it's going to require a correlated correction or some volatility in general. You know, if the dollar gets strong because there is a correction going on, right? The dollar gets strong, then everything falls for a hot minute. So those hot minutes are when you have to decide, okay, where do I really want to get involved? 32-ish. I think 32-ish. You know, it got up here, got rejected, started to come down, bounce back up. So this area here looks like pretty good support. Bad things would have to happen to go down in here. Okay. All right, we'll finish off with that. I'm going to talk about a couple individual stocks off here. Have a great weekend, everybody. Wear your mask.